Hi there, welcome to Kneppy Invest. I am listening to you. Quite a few of you, the viewers of this channel, have requested standard loan videos. Now, I used to do a lot of standalone videos, and even though they don't get nearly as many views as the ASX Daily Rundown video or any of those other more general, broad videos, you want more of these types of videos. So I've decided to start today on the 4th of September 2024, when the overall market is down a fair bit. I've decided to do a company, Stealth Group, whose share price is actually up today. Yes, Stealth Group, share price is up 7% when the overall market is down 2%. I'm a little bit surprised because the share price of Stealth Group has rallied a fair bit from when they released their results, showing there is a bit of strength to this company. The market likes their results, but I think the market likes even more the outlook for this company. Now, one of the reasons I like this company, not necessarily what they do, it's that the company has goals. They have aspirations, and those aspirations go out 4 years to financial year 28. And if this company reaches their financial year 28 goals, this company is looking quite cheap right now. And I'll discuss why I think so. So what I'll do in today's video, I'll go through their financial year 24 results, might go through their statements, and then also have a look at their presentation. Probably the other thing I should mention is a company, and this is actually just coincidence. I just saw that this company is doing a webinar for their financial year 24 results and outlook for financial year 25 and beyond on the 5th of September at 11:30 a.m. Australian Eastern Standard Time. So if you are watching or listening to this video before then, you have the chance to learn more about this company. I think this is the first time I've done a standalone video on the Stealth Group. Now, for full disclosure purposes, I am a shareholder of this company. And one of the reasons I bought some shares in this company, well, a few reasons, but one of the reasons I bought shares in this company, cheap. I thought this company was pretty good value. They're profitable, and now they're a dividend-paying company, but also because they have those goals. Okay, so let's get stuck into it. By the way, the market cap of this company at about 31 cents is roughly $36 million. 1 year return, 152%. Yes, about 1 year ago, you could have bought this company with a market cap below probably about $15 million. Now, I also should mention this company has a little bit of debt, so the enterprise value of Stealth Group is a little bit greater or more than 36 million. So let's go to their financial statements. Not that one, that's their investor webinar announcement. So let's go through this company's financial statements. Actually, before that, what does this company do? They call themselves a distribution company. And I do think they're being a little bit unfair on themselves. They're a little bit more than that. I'm just going to decrease this because it's way too much. There we are. So just go to their presentation or maybe even their website, because if you want to know more about this company, it's all there. And they do call themselves a large Australian public listed distribution company. I like that they say the word large because this company's market cap would make people assume that this company is a micro cap. Now, I think a company that is valued at $36 million is not small. It's a large company. $159 million of annual sales, distribute hundreds of leading brands known for quality, made for everyone, used every day. Now, one of the reasons why I do believe this company is underselling what they do, because not only are they a distributor, they're also a wholesaler and a retailer. So maybe you could call this company a diversified or maybe a vertically integrated distributor. I don't know. So a lot of going on, a lot of industrial products, safety products, automotive, workplace, and consumer technology. I believe and I'll verify this in a moment when I go through the presentation. I believe most of the revenue is made through the industrial sector. But we'll look at this particular presentation later in the video. So let's go back to their financial statements. One of the first things I noticed when I saw the results of this company was a slight decrease in revenue from $111 million to $113.7 million. Now, on first thought, I thought, oh no, revenue's gone up just a tiny bit. I expect a little bit more revenue growth, but they have improved or expanded their margins. So even though revenue hasn't increased all that much, profit has increased, and profit actually increased from 902,000 to almost $1.4 million. Sometimes with these sort of companies that do exist on fairly low margins, even if you see a bit of an increase in revenue, some of those margins might have been suppressed and you see profit just absolutely collapse. So that did not happen for this particular company. Now, other thing I should mention is a lot of other retail companies, maybe not distributing companies, but distribution companies, but a lot of retail companies have seen their sales fall. So this is probably or possibly a sign of strength in Stealth Group. So let's go down from the profit and loss statement. By the way, earnings per share about 1.34 cents. So share price right now is 31 cents. So doing a simple maths means this company right now is on a P/E ratio of about 25, maybe, yeah, about 25 or so. So right now, I wouldn't necessarily say this company is cheap based off their financial year 24 numbers, but there is another reason why I think they might be considered cheap. So let's go to their balance sheet. So a few things I want to note here or um, look at here include debt. Does this company have debt? They do have debt. In fact, financial liabilities, 2.5 million. Probably going to ignore the lease liabilities, but that's a real cost. But in the current liabilities, financial liabilities at 20.9 million. So this company has a little bit of debt. Cash increase from 7.7 million to 10.1 million. The other thing I like to look at here is fairly quick look at working capital, like trade and other receivables, inventories, and trade and other payables. And one thing you do note is that inventories have increased from about $14 million to $21.7 million. So inventories have increased a fair bit. And that sort of increase in inventories can be a strain on cash flow because if you do increase inventories or if you see an increase in trade and other receivables while trade and other payables have decreased, which they have not for this company, that can be or can make the cash flow statement or the cash flows of this company seem small or lower than what you would expect. So let's have a look at the cash flow statement of this company. And here it is. So operating cash flow, 6.2 million, slightly lower than last year. But again, if you actually go to note C2, they will have a reconciliation of the profit to the cash flow statement. In fact, let's do that right now. C2. Here it is, reconciliation of cash flows using operating activities. And what I'm looking for here is any large numbers. And by far, the biggest number here is, maybe not by far, there is a pretty big decrease in trade and other receivables, 4.1 million. Where's inventories? There is a bit of an increase in inventories as well. So overall, there has been a change in working capital that has been, in this case, it actually has been beneficial for the operating cash flow because that trade or decrease in trade and other receivables is a fairly large amount. So up six, or cash flow is, or operating cash flow, 6.25 million. Okay. So let's go back to, if I can find it. No, that's the director's report. I don't want that. Let's go to the cash flow statement again. Brief look at this. Yeah, so cash flow positive, operating cash flow positive, 6.2 million. Not much capital expenditure. So they were roughly free cash flow positive of about $6 million. So the cash flow is a little bit greater or a little bit more than the profit. So if you just look at the cash flow statement, you might think this company is significantly undervalued. So free cash flow, 6 million. The market cap of the company is 36. So the company is currently trading on at 6 times free cash flow. They also repaid some financial liabilities, 3.2 million. So the cash flow or the cash at the end of the year could have been even greater if they didn't pay any debt. Okay, so let's go to the presentation. And I do like presentations. I will have to admit, if I did have a choice to look at anything, I'd look at the presentation. That's probably because I'm lazy, but they do make it nice to read and go through. Usually it's fairly ordered and that sort of thing. We've already looked at what they do. Key fundamentals. So when they released this presentation, the share price was 21 cents. Now it's 31 cents. So you can just see how much the share price has risen since the company released their financial results. So share price has almost risen by 50%. 1 year performance, 68% since then. Total shares in issue, 115 million. So the market cap at this point was 24 million. So now it's 36 million. So you could have bought the shares in this company much cheaper just 1 week ago. Anyway, and the maiden dividend, should not forget maiden dividend. Now, the dividend yield is going to be quite small. And I'll also be honest with you, I don't really care about dividends. Dividends are just a nice little a gift, but I will never ever make a decision to buy a company based off a dividend. In fact, if I think a company is paying too much of a dividend, I more than likely won't buy that company because I'm looking for growth. And dividends suppress growth. It's an absolute fact. Just think of management. They have capital allocation decisions to make. If a company is producing cash flow in their operations, what can they do? They can give the money back to their shareholders as dividends, or they can make acquisitions, or spend money to grow the company for the future, doing any numerous things, or maybe share buyback. So the worst thing, in my opinion, for growth for a company is to give all the money back that they produce in their operations to the shareholders in the way of dividends. Revenue facts, 6-year revenue growth, 475%. And this is where it gets interesting. Now, they're only mentioning here financial year 28 revenue targets and EBITDA targets, but we'll look a little bit more into this later in the presentation. So, financial year 28 revenue target of plus $300 million and a financial year 28 EBITDA target of plus 8%. I'm assuming that's margins. And if it's margin, that means they are expecting or targeting EBITDA to be about $24 million in financial year 28, which means right now they'll be trading on 1.5 times EBITDA. So again, that's fairly low, but there's more to the story as we go through the rest of this presentation. So let's keep going. A nice history. They haven't been around for that long, if I remember correctly, 2012 or something. They did mention that somewhere. And they listed, I forget when they listed, maybe 6 or 7 years ago. Anyway, financial year 25 to outperform financial year 24. Underlying annual revenue is now 159 million. They made an acquisition. That's the other thing I should mention. They made an acquisition to diversify even further into the consumer technologies. I forget what that company is called. I'm pretty sure they'll mention it soon. That's why they're saying that underlying annual revenue is now at 59 million. I'm pretty sure that's because of this acquisition. Let's have a look. So sales up 2.54%, but you notice that EBITDA grew, was that 15.5%? Profit up 48%. So expansion of margins. Now, net profit before tax up 48% and net profit after tax up 50%. So when you see profit, EBITDA growing at a greater rate than revenue, that implies margin expansion, which is a good thing. Cash of 10.1 million, fixed debt reduced by 55% to 1 million, net debt reduced to 4.9 million. However, they do mention that's before the Force Technology acquisition. So to acquire this Force Technology, they did have to take on a little bit of debt, maybe $6 million or something like that. Underlying sales, or maybe that underlying sales was for financial year 25. I don't know. Anyway, growth of 39%. So pretty nice growth in sales, but again, that's because of this acquisition. Talking about contracts won, retail reseller store channels, and financial year 28 growth pipeline, 141 million. Now, what they've also mentioned here, the majority of that growth is organic. So 75% growth organic or through organic. So that's just growth in the company, and 25% inorganic growth, which is through acquisitions. So when I actually did see that, that sort of, I was a little bit wary about that revenue target. So I thought maybe they're just going to acquire, and that's just how they're going to grow, just by acquiring new stuff, which sometimes is not beneficial for shareholders. But they are targeting that 3/4 of their growth is going to be organic. And that sort of did allay some of my concerns about their targets. Go through some of their key financials. So nice growth in all except maybe revenue. But I think the revenue, we'll give them a pass here because most retail companies, even though this company is, they call themselves a distribution company. I'm calling them a retail company. Most retail companies have seen a decrease in revenue. Operating cash flow, already talked about that. Free cash flow, already talked about that. Although they've got their free cash flow a little bit lower. So I didn't really include lease liabilities. I probably should. But anyway, it doesn't really matter all that much. What else do we have here? Net assets, net debt. So I think we can move on. Just talking about the history of the company, this is exactly what I like to see: growth in everything. I do prefer, this is just me, I do prefer most of these metrics to be put into uh, per share. So I do prefer revenue per share growth, EBITDA per share growth, even profit per share growth, which is earnings per share. So I do prefer that, particularly for companies who are increasing in their shares on issue. Net debt's been dropping, however, has increased 5.9 million because of this acquisition. So it's up about or over $10 million as we speak. Uh, they're focused on winning. There you go, Reynolds or brands. There's my what's it called? Spoonerism. I just said Reynolds or something. So brands, channels, and customers. We can move on. Sort of thing I don't like. Company overview. You can move on from this. If you want to know more information, just go through this presentation or go to the website. I do like websites. There's some businesses, so industrials, and most of their revenue is generated in this industrials group. So we're talking about Heatley's, and most of these companies I've never heard of. Heatley's, United Tools, Tool Center, ISG, which is Industrial Supply Group, and Trade Member Direct. But that acquisition of Force Technology was the Consumer Technology Group. Yeah, they've got an even nice little picture of JB Hi-Fi. So maybe they're developing a relationship with JB Hi-Fi. So Force Technology operates as a wholesaler and distributor of consumer technology accessories, which I have no idea what they would be, through approximately 3,310 retail reseller stores across Australia. They do mention like what they're serving, so I probably not included any of this. For instance, they've got carpenters and concreters and stonemasons, window fitters, glaziers, automotive, chemical, waste management. I don't fit into any of that. 77% of total sales are generated from mining, resources, mining services, infrastructure, construction, manufacturing, transportation, and trade sectors. Here's some of their brands. I've only heard of Belkin. Rest I've never heard of. And talking about industrial, so they're sort of, I suppose now they have two divisions: industrials and consumer technology, because of this acquisition of Force Technology. Let's move on. Highlights for financial year 24, all celebrating 10 years. So they were created in 2014. So again, not an old company at all. I just talked about how they've done in financial year 24. We can move on. Achievement checklist at a glance. Yep. Group progress on strategy. Yep. Sales by product. I like these sort of things. So 52% sales are in the industrial sector, 30% safety, 8% workplace, 9% automotive, and 2% consumer technology. It's going to be interesting to see how much of their revenue is now going to be coming through or going through the consumer technology with that acquisition. So we'll be able to see that probably next year or maybe even in a half year. Talking about store networks as well. So for instance, Heatley's has 10 stores. Force Technology, they don't have 4,330 stores, but they do sell to 4,330 stores. So I'm assuming there are like 10 literal Heatley stores, but I could be mistaken about that. A few skipper transport parts have been rebranded Heatley. So according to this, there's 0. Oh, that's 2025. So this is what they're planning to do, or decrease or increase the amount of stores. So higher one's going from 0 to 20. USC is going from 1 to 10. So a bit of expansion in store counts there. Individual business highlights, quite a bit to go through there. So I won't do it in this particular video. So you can just see how the individual companies are performing for Stealth Group. Financial performance, yeah. I do like how they have 4 years of history here. So you can see that the revenue has increased from 67 million to 113 million in the last 4 years, and profit has gone from 600,000 to 1.4 million. They don't mention, and return on capital employed has gone from 6.1% to 13.8%. Okay, talk about the income statement. Sometimes they do have really interesting commentary in regards to anything here. So let's see if they have anything interesting here. $1.2 million in e-commerce platforms. Okay. And they do talk about repayments of some of the debt and the balance sheet. Inventory reduction. I thought there was an inventory increase. Inventory reduction representing 13% of sales. Oh, they're talking about in percentage of sales, maybe. I don't know. Just got inventory reduction representing 13% of sales. Oh, okay. So they're it's got oh, that's a confusing statement. I sort of can understand it if they were including force, but they're saying excluding force. But sales are flat, but inventories have increased 7 million. Maybe the increase in inventories is because of the force acquisition. Maybe I should assume that. So they're really focused on return on capital employed, group debt management. I like this sort of thing because they do have a little bit of debt. How are they going to manage that debt moving forward? And interest on that debt was a fairly large cost, if I remember correctly. So if you go back to maybe even the balance sheet, they have it here. So interest paid was $1.179 million. So they had no debt. This company would have been even more profitable by a fair bit, in fact. So debt is, and interest paid on the debt is a fairly big cost for this company. And debt management, which excludes force pre-requisition. Dividends, don't really have to talk about dividends. Outlook, this is where it becomes interesting for this company. So they're targeting at 300 million, but I'm just going to show you what I really liked here. Here it is. Is it this one? No, it's not that one. Well, it might be that one. I think it might be that one. Let's have a look. Revenue. Yeah, it is this one. So this is really interesting because even though they haven't directly told us their financial year 28 profit forecast, they sort of do it here. So NPAT percentage of sales. So between 1.5% and 3%. So if you get your calculator, so they are forecasting, not my calculator. So they are forecasting profit percentage to be between 1.5% and 3% of sales. We already know they're targeting $300 million of sales. So straight away, we can actually give or provide or calculate what their financial year 28 profit target is going to be. So 300 million times 0.015. So the lower end of their profit target or the profit range is 4.5 million. I'm assuming just double that to 9 million. So they are targeting their profit to be between 4.5 million and $9 million in financial year 28. And don't forget, this company currently has a market cap of $36 million. So if they do achieve this nice growth in profit, so they're thinking of maybe close to tripling profit in the next 4 years. This company right now is pretty good value, trading on a forward-looking PE of as low as 4, and as high, if they do achieve these goals, as high as about 8 or 9. So yeah, very interesting that you do or can see what sort of profit targets they are aiming for. So between 4.5 million and $9 million. And that's what is probably the key for me when I went through their outlook. In fact, that was probably the key takeaway I took from this particular presentation is they are expecting significant growth, not only in terms of revenue, but also in terms of profit. Okay, so let's have a look right now, back to the share price. Oops, still at 31 cents. So let's have a look at the chart for this company. So this is the next important thing. And of course, it's going to take a while to open up for some reason. I don't know why. I do have fiber to the premises. So SGI. And yeah, the share price has been a beautiful uptrend since about the middle of 2023. So we're talking about 1 year. The share price has risen from about 12 cents all the way up now to 31 cents. So the market is becoming aware of this company, even though it is still small. And probably the most important thing is the volume. Now, I do drone on about volume, how important volume is. And over the last 4 days, since they released their results, the volume has exploded. Someone is interested in this company. It could be a fund manager or two taking a position in this company. Maiden dividend, profitable, nice goals for the future. And if they achieve those goals, this company is looking fairly cheap. And I just am intrigued by this pretty substantial increase in volume over the past 4 to 5 trading days. That's typically a good sign for these type of companies. These companies that are on fairly low market caps. If you do start to see the volume increase, that could be a good sign for the future. Not only that, share price today, on a pretty bad day for the market, has reached probably an all-time high at 31 cents. And I would call this a breakout. I expected a bit of weakness in the share price of this company today. That did not happen. Okay, so that's all I got for Stealth Group. Fascinating company. Probably not the sort of company I would be searching out for because of the business model. They exist on fairly low margins. You can see that they had over $100 million of revenue, but their profit was fairly low. So really low margins. But when a company like this has really low margins and they are growing, there is a potential, and they showed it in financial year 24, there is potential they could experience margin expansion. They become more efficient, that sort of thing. And we have seen that in financial year 24. And there's possibilities we're going to see that over the next few years. So this company could be an absolute growth engine, not only for revenue, but also profit and all those other interesting, even dividends over the next 3, 4, 5, maybe even 10 years. Okay, so that's all I got for Stealth Group. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.